Hi students, so welcome dito sa discussion for partnership dissolution. So we're done with partnership operations and partnership formation. So partnership formation was the first part of our accounting series for partnership. Then part 2 naman yung partnership operation. Then part 3 si partnership dissolution. Then dissolution will be divided into two parts, part 1 and part 2. Okay. So for our discussion for partnership dissolution, our focus points for this discussion is to discuss the concepts of partnership dissolution and account for admission of new partner. Okay. So admission of a new partner is one of the considerations in accounting for partnership dissolution. So later on, we're going to discuss further about partnership dissolution. So let's start with the concept of partnership dissolution. Partnership dissolution means there is only a change in the ownership interest or structure of the partnership itself. It doesn't mean that the partnership is dissolved, the partnership no longer exists. Well, to be exact, the old partnership cease or dissolved, nawawala na, na-terminate yung old partnership, but another partnership is uh, reborn or parang created. Okay? So the partnership still continues. Although the structure of the partnership is no longer the same than what it is or what it was before. Okay, the old partnership no longer exists and but the business still remains. Then another partnership will continue the business operations. So that is what it means by partnership dissolution. Okay, so there is no total termination of the business, rather continuation because of a new partnership that will exist. Okay, example, A, B, and C are partners in ABC partnership. So they form partnership. Okay, if D is admitted as a new partner in the partnership of A, B, and C will be dissolved. Okay, because a new partnership will be formed. It is already the partnership of A, B, C, and D. Okay, the existing partnership of A, B, and C, which is ABC partnership, will be dissolved. Okay, then another partnership will be formed, which is partnership of A, B, C, and D. Okay. Another thing is if C decided to retire or withdraw from the partnership of A, B, and C will be dissolved. Okay, the partnership of A, B, and C will be dissolved because the remaining partners, if C will retire, A and B na lang. Okay. Then another example, if A dies from for some reason because of illness or some sample accident, okay, the partnership of A, B, and C will also be dissolved. Then since due to the death of partner A, then partners B and C will remain and will continue the partnership. Okay, and another thing, if they decided to convert the partnership into a corporation, of course, that would be a total change in the operation of the business from being a partnership to a corporation. Then the partnership will really be dissolved, but the operation is still there naman. Okay, A, B, and C will still be there. They will still remain. The business will still remain, but no longer a business organization of partnership, rather as a corporation. Okay. So therefore, the common reasons of partnership dissolution can be summarized as follows. We can have it admission of a new partner, which is our focus after this, discussion of the concepts of partnership dissolution. Another one is retirement or withdrawal of an old partner from the partnership. Then death of a partner. And last is conversion of a partnership into a corporation. So therefore, our discussion for partnership dissolution, okay, will discuss the four common reasons. So the other three reasons will be discussed in the part 2, from retirement down to conversion of a partnership into a corporation. Okay, So let's start with admission of a new partner. Okay. So admission of a new partner, if a new partner is admitted in the partnership, the admission may be done through some considerations divided into three. We have it here. The admission of a new partner may be done through purchase of capital interest from only one partner. Therefore, the admitting partner or the new partner will purchase capital interest from only one partner, okay, one of the partners, or uh, the new partner, okay, or the admitting partner will uh, purchase capital interest from all of the partners, or the new partner will not purchase, rather he or she will invest in the business, okay, or in the partnership. If the partnership admits a partner through purchase of capital interest from only one partner, the following considerations may be accounted for. So, purchase of all or portion of the interest of that one partner. Okay? So, therefore, an admitting partner may purchase all or portion of the capital interest of that one partner wherein he or she will purchase. Then regardless of the amount paid, capital credit is equal to the purchase interest. Meaning, regardless of the amount na ibinambayad ni admitting partner dun sa partner kung saan siya bumili ng capital interest, the capital credit will still be the same. So if the purchase interest is 1 million, then 1 million yung i-credit regardless if the amount paid is more than 1 million. Okay? More than or less than 1 million. Okay? Cash payment is personal between the selling partner and the buying partner. Okay? The partnership does not account for that cash payment between the uh, transacting partners, the selling partner and the buying partner. Then new set of profit or loss ratio is agreed. Okay? It depends. Based on the agreement of the partners, they can actually retain the old partnership profit or loss ratio. Okay? But a new partner will hold the profit or loss ratio held by the previous partner. But again, as a rule, they will agree to create a new set of profit or loss ratio. Example, purchase of interest from one partner. The partnership of REM, and RIM has capital balances as follows. For RAM, 50,000, REM, 65,000, and RIM, 55,000. Their profit or loss ratio is 3 is to 5 is to 2. So meron silang ratio. It is a total of 10 or in a 100% base. With the knowledge and consent of REM, and RIM, RAM and RIM sold his capital interest in full to ROM. By the way, when it comes to admission of a new partner in partnership dissolution, always take note that everyone must agree. Okay, everyone must agree. Everything that is happening in the partnership be uh, must be done through agreement. Okay, so admission of RIM, okay, our admission of ROM, okay, and the selling of RIM's interest to ROM must be uh, in agreement. Okay, RAM and REM must agree with the um, transaction. So RIM was paid in cash and ROM will be admitted as a new partner in the partnership. Okay, so how we're going to account for this one? So our solution, since RIM is selling full of his interest, so we have to remove the RIM capital. So therefore, RIM will no longer be a partner in the partnership because he's selling the full amount of his capital credit or capital interest in the partnership. So we debit RIM capital and credit ROM capital for 55,000. Since in the problem it is provided that RIM has 55,000 capital balance, therefore, upon admission of ROM, the same amount of capital balance will be credited to his capital account, regardless of the amount paid. Okay? So therefore, the capital balances after the admission of Rome still be the same, 50, 65, and 55. However, the structure of the partners, okay, of the organization is already RAM, REM, and ROM. No longer RAM, REM, and RIM. Okay? So after the admission of Rom as a new partner, Rom's capital credit is equal to his purchased capital. So he purchased 55,000 of RIM, so the same capital credit to his account. Then the partnership of RAM, REM, and RIM is dissolved because RIM sold all his capital interest to ROM. Then cash payment is personal between RIM and ROM. Regardless of the amount involved in the cash payment, okay, it is personal between RIM and ROM. The partnership will not take advantage or will not take into account anything when it comes to cash payment, which is personal between the transacting parties. Then RAM, REM, and ROM may agree to a new set of profit or loss ratios. Okay? Next is another example, purchase of interest from one partner. Okay? So the same set of partners, RAM, REM, and RIM, capital balances 50,000, 65,000, 55,000. The same profit or loss ratio, 3 is to 5 is to 2. Then with the knowledge and consent of RAM and REM, RIM sold half. Take note, on the previous example, full. Okay, here we have it half. His capital interest to ROM. RIM was paid in cash and ROM will be admitted as new partner in the partnership. Here, the solution or to account for the transaction is to debit a portion of RIM capital and credit the same amount to ROM capital, which is equivalent to half of the 55,000 capital credit of RIM prior to the admission of ROM. So 55,000 divided by 2 is 27,500. So since ROM is purchasing half of RIM's capital, so RIM will be reduced with 27,500 and the same amount would be credited to ROM capital, 27,500. Then after the admission of ROM, the capital balances of the partners, by the way, there will be 4 partners in all because there will be no exiting of a partner. Okay? No withdrawing of partner, only a purchase of a portion of the capital interest of an existing partner. So for RAM, still 50. For REM, still 65. But for RIM and ROM, will have equal amounts of 27,500. Okay? And ROM will be a new partner. So after the admission of ROM as a new partner, ROM's capital credit is equal to his purchased capital, which is half of RIM's capital. Then the partnership of RAM, REM, and RIM is dissolved. Why is that so? Because another partner has been admitted with, which is ROM. So a new partnership arises, RAM, REM, RIM, and ROM. Okay? Then cash payment is personal between RIM and ROM. Always take note of that. Then RAM, REM, RIM, and ROM will set out new set of profit or loss ratios. They can no longer retain the old profit or loss ratios because that old ratio is only referring to the 3 old partners. Okay? Since there are already 4 partners, they really need to set out new set of profit or loss ratios. Okay? Next, purchase of capital interest from all partners. The purchase of capital interest from all partners is somewhat the same procedure with purchasing capital interest from one partner. Only that you are accounting a purchase. It's like you are consolidating the capital interest purchased from all of the partners. So the purchase of portion of the interest only. Here, you cannot purchase all interest from all partners. Okay, because partnership will cease in that case. So commonly, the purchase is only portion of the interest of all the partners. So that partnership will continue. Then regardless of the amount paid, the capital credit is equal to the purchase interest. Somewhat the same with, not somewhat, but really the same with what we have in the previous example or previous uh, concept. Then all partners may agree to a new set of profit or loss ratio. Then cash distribution may either through the ratio of capital interest transferred or old ratio. This is referring to the cash payment. Since the admitting partner will pay the partners, all the partners, uh, with regards to the purchase of the interest, then the old partners uh, may divide the cash payment among themselves on the basis of the capital interest transferred or the old ratio that they have, okay, or profit or loss ratio. Okay. Example: uh, the partnership of RAM, REM, and RIM has capital balances as follows: still 50,000 for REM, for RAM, 65,000 for REM, and 55,000 for RIM. The profit or loss ratio is 3 is to 5 is to 2 with the knowledge and consent of all the partners. ROM will be admitted as a new partner by purchasing 20% of the capital interest from all partners. So meaning, ROM will be purchasing 20% of RAM, 20% of REM, and 20% of RIM. ROM paid 40,000 cash to be divided by the partners using their old profit or loss ratio. So they agreed that they will divide the 40,000 cash payment using the 3 is to 5 is to 2 old ratio. So how we're going to account for this transaction? Okay. So compute first the interest that had been purchased by ROM. So 50%, 50,000 times 20% for RAM is 10,000. From REM, 65,000 times 20% is 13,000. Then for RIM, 55,000 times 20% is 11,000. So that a total of 34,000 total purchased interest by ROM. Okay, so the capital credit of ROM will equal to 34,000. And because there is a purchase, respective amounts of respective computed amounts will be deducted from RAM, REM, and RIM. Okay. So to journalize the transaction, we debit the capitals of the old partners for the respective purchased capital on each of them. Then ROM, credit ROM capital for the total of 34,000. Okay? So the capital balances after the admission of ROM. So for RAM, will go down 40,000. For REM, we have 52,000. For RIM, we have 44,000. And for ROM, we have the 34,000 purchased interest. Okay? Then the distribution of cash payment to RAM, REM, and RIM will be based on the ratio 3 is to 5 is to 2 or 30%, 50%, 20% old ratio. So for RAM, it is 12,000. Then for REM, it is 20,000. And for RIM, it is 8,000. So total cash payment is 40. Okay? Next, after the admission of ROM as a new partner, ROM's capital credit is equal to his purchase capital, which is in the example, we have it 34,000. Then the partnership of RAM, REM, and RIM is dissolved. Okay, because a new partner is admitted, which is ROM. New partnership arises, okay, RAM, REM, RIM, and ROM. Then cash payment is personal between ROM and the old partners. Okay, evidence of the cash payment distributed to each partner, labas na yung partnership dyan. Okay, yung partnership itself. Hindi mangingialam yung juridical personality na partnership, but personal only to the partners. Then RAM, REM, RIM, and ROM will set out a new set of profit or loss ratio. Another example, the same capital balances, the same profit or loss ratio, 3 is to 5 is to 2. Then with the knowledge and consent of all the partners, ROM will be admitted by purchasing 25% capital interest from all partners. Then ROM will be paying 50,000 cash to be divided by the partners using the ratio of their transferred capital. So in the previous example, the basis was the ratio of 3 is to 5 is to 2. But this time, the basis will be the transferred capital. So how do we account for that? Compute first the purchase interest of ROM. So that will be 12,000 from RAM, 12,500 from RAM, 16,250 from REM, and 13,750 from RIM. So a total of 42,500 for ROM. So the journal entry is to debit the capitals of the old partners, RAM, REM, and RIM for 12,500, 16,250, and 13,750 respectively, and credit ROM capital for the total of 42,500. Now the capital balances after the admission of ROM. So RAM will have 37,500, REM will have 48,750, and RIM will have 41,250. Then ROM, the total of purchased capital of 42,500. Okay? Then the distribution of cash payment to RAM, REM, and RIM will be on the basis of their capital transferred. Okay? So 12,500, 16,250, 13,750, total of 42,500. Make a fraction or make a ratio or make percentage out of it. So for RAM, 29.41%. For REM, 38.24%. And for RIM, 32.35%. A total of 100% base. Then the distribution of the cash payment for RAM, it is 14,705. Then for REM, it is 19,120. Then for RIM, it is 16,175 pesos. 16,175. A total of 50,000. Kasi 50,000 naman lahat yung cash payment. So after the admission, capital credit of ROM is equal to its capital purchased, capital interest purchased. Dissolve the partnership of RAM, REM, and RIM. Then a new partnership arises, RAM, REM, RIM, and ROM. Cash payment again is personal between the partners, ROM and the old partners, and the new partners, the new set of partners will set out new profit or loss ratios. It's up to them. How are they going to agree on that? Okay. The next, new partner invest into the partnership. So we're done with the assumption that the partners, that the new partner, the admitting partner is purchasing interest from the old partner. So this time, the new partner or the admitting partner will invest rather than purchase. Okay, so scenarios will be different from this point because we're going to consider the contributed capital of the partnership or of the partners when accounting for investment of a new partner in the admission in the partnership. So scenarios could be the contributed capital may be equal to the agreed capital of the partnership, or the agreed capital will not be equal with the contributed capital. Okay, either the agreed capital be greater than the agreed capital will be greater than the contributed capital, or the agreed capital less than the contributed capital. So what is the rules for this one? So the rules, we can summarize it this way. Okay, so let's start first with contributed capital is equal to agreed capital. If the contributed capital is equal to agreed capital, no revaluation of asset needed, and no goodwill is recognized. Okay? Some of the books provides that there will be no bonus. Okay? But some books present it, bonus may apply as long as the contributed capital and agreed capital will be equal. Okay? So for bonus method, new partner gives bonus to old partners, or the old partners give bonus to the new partner. Then respective capitals are adjusted by the bonus. Then the partnership capital will be the old capital plus the new investment. Okay? Okay. So The scenario if the contributed capital is not equal to agreed capital, then there could be revaluation of asset either up or down, revaluation of asset up or revaluation of asset down. There could be recognition of goodwill, okay, either recognition of goodwill by old partners or recognition of goodwill as part of the account of the new partner, or bonus method will be applied. Okay? Among the three, mas common po yung goodwill at bonus method. Although, in practice, uh, bonus method yung mas common between goodwill and bonus. Because goodwill method is much more applicable with business combination. Since partnership is not a business combination, rather association only of two or more person, then goodwill method should not be considered. But because we are here for concept purposes, discussion purposes, we're going to discuss goodwill method. Okay? So if it is a revaluation of asset up, so there's an upward asset revaluation, assets are revalued at its fair value upward, then old partners share in the revaluation increase. So after considering increase in the asset, then the old partners shall took effect first the increase. They are to adjust their capital balances with the increase, okay, in the value of the asset. Then the partnership capital will be the old capital plus the new investment plus the revaluation increase. If it is revaluation asset down, just the reverse concept. So revalue the asset at fair value downward. Then old partners will also share in the decrease in the value of the asset. So they have to adjust their capital deducted by the decrease. Then partnership capital will be the old capital plus the new investment, then minus the revaluation decrease. Okay. Then for goodwill method, okay, for goodwill method, referring to old partners is to recognize the goodwill. If the goodwill is referring to the old partnership, then old partners share in the recognized goodwill. By the way, we are referring here with the full goodwill. Okay, but okay. Partnership capital will be the old capital plus new investment plus the goodwill to old partners. Okay? If the goodwill is referring to the account for the new partner, then the goodwill will be considered part of the capital balance of the new partner. Then old partner's capital is unchanged; it will not be adjusted, but the partnership capital will be the old capital plus the new investment plus goodwill by new partner. Okay, so this time the new partner will be recognizing goodwill. Then for bonus method, apply the bonus method that we have earlier. Okay. So let's have an example. Uh, Agreed capital is equal to contributed capital. So bonus to new partner. So let's start with the bonus to new partner. Partnership RAM REM RIM has capital balances of 50,000, 65,000, and 55,000. Profit or loss ratio is 3 to 5 is to 2. ROM is admitted as a new partner and is to invest 30,000 for 25 interest in the partnership plus 20,000 bonus from old partners upon his admission. So, nag-invest siya ng cash for a capital credit of 25%. I mean, for capital interest of 25% in the partnership, plus there will be a bonus on his part from the partner. So, how are we going to account for this transaction? So, let's have this analysis. Okay, mas kilala to sa mga books as tic-tac na tic-tac analysis. Okay? So, we have it here. The percentage column, the old partnership in capital interest, that's 100% base ng profit or loss ratio nila. Then yung contributed capital, the contribution of RAM, REM, and RIM, the old capital balances, then ROM, the 30,000. Then since bonus will be given to the admitting partner, So the 20,000 bonus will be added to ROM and will be distributed accordingly to the old partners. So 50,000 will form part uh, the new the agreed capital will form part the agreed capital, new agreed capital of still the same at 200,000, but the bonus will be distributed accordingly to the old partners. RAM will be deducted 6,000, then REM will be deducted 10,000, and RIM will be deducted 4,000. How did we get this amount? 20,000 times 30%, we have 6,000. 20,000 times 50%, we have 10,000. And 20,000 times 20%, we have 4,000. So after the admission, the capital balances of the partners are 44,000 for RAM, 55,000 for REM, 51,000 for RIM, and 50,000 for ROM. As you can see, the contributed capital 200 is equal to agreed capital 200. Okay. So to journalize the transaction, debit cash 30,000 for the investment of ROM, then ROM capital for 30,000. Afterwards, recognize the bonus, debit the capitals of the old partners, RAM, REM, RIM, for 6,000, 10,000, and 4,000 respectively, then credit ROM capital for the bonus of 20,000. Okay? Next, AC is equal to CC bonus to old partners. Okay, bonus to old partners, therefore, the same problem, the same capital balances and ratio. ROM is admitted as a new partner to invest cash of 50,000 for 15. Okay? 15% in the partnership upon its admission. So 15% interest in the partnership lang daw. 50,000 niya kanyang i-invest pero 15% lang yung kanyang interest. So how do we journalize this transaction? Okay, the same analysis, yung parang TikTok. So 50,000 yung contribution ni yung investment ni ROM. Then since ROM is referring to 15% interest, okay? So we have it the total contributed capital will be 220,000, so it must be the same here, 220,000. So 220,000, it is 15% of this one is 33,000. Okay? Then to reduce the capital credit to 33,000, there must be a bonus that will be provided to the old partners. So 50,000 minus 17, that will be 33. Then this 17 will be distributed accordingly to the old partners. 17,000 times 30%, that would be 5,100 to to RAM. Then 8,500 to REM, and 3,400 to RIM. Then the capital balances after the admission, which is under the agreed capital column, 55,100 for RAM, 73,500 for REM, 58,400 for RIM, and 33,000 for ROM. By the way, in the previous problem, let's go back. This 50,000 is actually 25% of this 200,000. Okay, 200,000. Kindly check for the computation. Okay. So the journal entry to record the admission is debit cash for the investment of 50,000 and credit ROM capital 50,000. Then took effect the bonus to old partners, debit ROM capital 17,000 and credit RAM, REM, RIM capital for 5,100, 8,500, and 3,400 respectively. Okay? Then another example, no bonus to or from partners. AC is equal to CC. So the same capital balances, the same profit or loss ratio. RIM is admitted. I mean, this should be ROM. So ROM is admitted as a new partner and is to invest 30,000 for a 15% interest in the partnership. Okay. So to account for the transaction, so ROM will have the same, no bonus to or from partners. So contributed capital will be total 200,000 since no bonus to or from. This will be the same here, 200,000. So 15% of 200,000 is really 30,000. So the same capital balances after the admission of ROM. 50,000, 65,000, 55,000, and the capital investment of 30,000 respectively to RAM, REM, RIM, and ROM. Okay? So the journal entry is only to debit cash 30,000 for investment of ROM, then ROM capital 30,000. Okay? Then let's move forward if uh, contributed capital is not equal to agreed capital. Let's have first revaluation upward. Okay, therefore there is a revaluation of asset. Okay? So the same capital balances for the old partners RAM, REM, and tsaka RIM. The same old ratios of 3 is to 5 is to 2. ROM is admitted as a new partner and is to invest cash of 50,000 for a 20% interest in the partnership. So investment of cash 50,000, then 20% yung capital interest. Any difference in the investment and the purchase interest is proportionate to the undervaluation of land with fair value of 100,000 and book value of 70 and to be paid by ROM. Anong ibig sabihin yan? Any difference daw in the capital interest purchased in the investment and the purchase interest is proportionate to the undervaluation. Okay? So how do we account for the transaction? Computation of the undervaluation, the fair value of the land, 100,000. Book value of the land is 70,000. It is a full undervaluation, 100% undervaluation. Bakit 100% undervaluation siya? Kasi nga given yung value ng land at saka ng fair value and book value ng land itself. So full, binigyan tayo ng value ng asset. So yung 30,000 is a full undervaluation. Why is it undervaluation? Because the actual value of 100,000 is higher than the recorded amount of 70,000. What is in the record is less than 30% of what is the actual value. So under valuation 30,000. So this 30,000 will be distributed and be taken effect as an increase in the capital balances of the old partners. So the old partners will share in the undervaluation based on the 3 is to 5 is to ratio. So for RAM, we'll have 9,000. For REM, we have 15,000. And for RIM, 6,000. Then took effect the increase in the capital. So we'll have it later. So computation of capital interest of ROM after evaluation, the old partnership capital of 170,000, the total of 50,000, 65,000, and 55,000, plus ROM's interest of 50,000, ROM's investment of 50,000, then add the revaluation increase of 30,000, the total adjusted capital, or so should I say the agreed capital of 250,000. Okay, then divide that multiply that amount with the interest ratio of ROM, which is the 20%. So ROM's capital interest credit will be 50,000. Okay. So in our analysis in the TikTok, okay, RAM, REM, and RIM will receive respective share in the revaluation increase. Okay, and no amount for Rom because wala namang bonus or wala namang revaluation increase for him. So for Ram, after the admission of Rom, we have it 59,000. For Rem, we have 80,000. And for Rim, 61,000. Then for Rom, 20% yan, 50,000 dito. Okay? If you will consider computing 20% of 250,000, it is really 50,000. Okay? Yan. The total revaluation will increase the CC or the contributed capital from 220,000 to 250,000 because of the 30,000 undervaluation, or should I say the revaluation increase. So debit cash for the investment of ROM, then credit ROM capital 50,000. Then debit land to increase the value of the land for 30,000, then credit the capitals of the old partner, RAM, REM, and RIM for 9,000, 50,000, 15,000, and 6,000 respectively. CC is not equal, revaluation downward. Okay? ROM is admitted as a new partner and is to invest cash 60,000 for 30% interest in the partnership. Then, any difference, purchase interest and investment proportionate to the overvaluation of land and with fair value of 70 and book value of 100. So there would be overvaluation in this one. So there will be revaluation downward. So to compute for the overvaluation or the revaluation decrease from 100,000, we have to revalue it at 70 because mas malaki yung na-record kaysa sa actual amount. So overvaluation ng 30,000. Okay? Then compute the share in the overvaluation. RAM will have 9,000, REM will have 15,000, and RIM will have 6,000. Okay? The same amount of 30, yun nga lang overvaluation this time. Then to the computation of capital interest of ROM after the revaluation, need the old partnership capital of 170,000 total plus the ROM's investment of 60 minus revaluation decrease of 30. So to the total adjusted capital balance or the agreed capital is 200,000 multiplied by the interest ratio of ROM of 30%. So we'll have ROM's capital credit of 60. Okay? So in our analysis, the total contributed capital of 230,000 mababawasan daw ng 30,000 decrease, revaluation decrease. So we'll have it to 200,000 agreed capital. So yung 60,000 multiply 200,000 multiplied by 30% will be 60,000 talaga. Then the respective balances of RAM, REM, and RIM after the admission of ROM will be 41,000 for RAM, 50,000 for REM, and 49,000 for RIM. So debit tayo ng cash for the investment of ROM, 60,000, credit ROM capital, 60,000. Then debit the capital balances of the old partners, RAM, REM, and RIM for 9,000, 15,000, and 6,000 respectively, and credit the account land to signify the decrease in the value of land. Okay, 30,000. Next, CC is not equal to AC, goodwill to old partners. So goodwill will be recognized by the old partners. Okay, Rom is admitted as a new partner and is to invest cash for 60,000 for 20% interest in the partnership. Any unidentifiable asset pertains to the partnership and shall be recognized as shared by the old partners. So how do we going to account for this one? So computation of the goodwill, Rom's investment 60,000 will be our basis on the computation of the new agreed capital because the problem provides na mag-invest siya ng cash for a 20% capital credit. Okay? So 20%, 60,000 divided by 20%, the agreed capital will be 300,000 versus the contributed capital na 170,000 plus 60,000 investment of Rome, 230,000 contributed capital lang yan. So the difference will be full goodwill. Okay? Full goodwill. Because ito, 100% na yan, then ito 100% din, then the goodwill will be 100% din. 70,000. Then the old partners will recognize share in the full goodwill. So sila lang yung mag-share sa goodwill na to. Okay? So for RAM, we have 21,000. For RAM, we have 35,000. And for RIM, 14,000. On the basis of the 3:5:2 capital, profit or loss ratio. Then the computation of capital interest of ROM after this should not be revaluation, rather goodwill recognition. So 170,000 plus ROM investment plus full goodwill. Then total adjusted capital 300,000 or the agreed capital times 20%. It's really capital 60,000 capital interest for ROM. So ayan, ito yung analysis natin. Since goodwill, old partners will share in the 70,000, RAM will have 71,000, REM will have 100,000, and RIM 69,000, and ROM will have 60,000 after his admission. So a total of agreed capital of 300,000. Okay? So 230,000 na contributed capital will be increased by 70,000 goodwill, so it is proper to have 300,000. So debit cash for the 60,000 investment of ROM, then credit ROM capital 60,000. Then goodwill debit 70,000, then recognize the share in the goodwill through credit in the capital accounts of the old partner, RAM, REM, and RIM for 21,000, 35,000, and 14,000 respectively. Okay. Next is goodwill to new partner. This time, the new partner will recognize the goodwill into his account. So, Rom is admitted as a new partner and is to invest cash for 30,000 for a 20% interest in the partnership plus any goodwill upon his admission. Old partner's capital remains unchanged. Okay? So, computation of the goodwill will start with the old partnership capital since Rome will have 20%, then the remaining percentage or interest will refer to the old partnership capital, which is 170,000. Divide it with 80%. So the agreed capital should have been 212,500. Then versus the contributed capital, which is 170,000 plus 30,000 investment of Rome, which is total of 200,000. We can have full goodwill of 12,500 only to be accounted as part of the capital of Rome. So the old partner will not share for this one, but will be credited directly to Rome's capital. So the computation of capital interest of Rome after the recognition of the goodwill, this should not be revaluation, and they have corrections na lang. So all partnership capital 170,000, Rome's investment 30, full goodwill 12,500, total adjusted capital 212,500 or the new agreed capital times interest ratio of 20%. We have Rome's capital interest 42,500. So ayan yung ating analysis. Wala namang bonus or wala namang goodwill na i-recognize yung old partners, so the same capital balances 50,000, 65,000, and 55,000 respectively to RAM, REM, and RIM. But ROM will be recognizing goodwill of 12,500. So from 30,000, we'll have 42,500. Okay? So debit tayo ng cash for 30,000 and credit ROM capital for 30,000 for his investment of 30,000. And debit goodwill and ROM capital for the 12,500 na goodwill. Okay? Then we'll have bonus to old partners. CC is not equal to AC. Okay? Parang the same lang actually yung dito, accounting when it comes to bonus method. So Rome is admitted as a new partner and is to invest cash 60,000 for 20% interest in the partnership. So bonus to old partners. Okay? So therefore, we can expect that uh, Rome will have a smaller amount of capital credit than his investment. So, computation of bonus to old partners contributed capital, which is the total of 170,000 old partnership capital plus the investment of 60,000, so 230,000, um, multiplied. This should have been multiplied. Wait, let me correct this one. Yeah. Okay. So computation of the bonus to old partners. So we have it again, the total of 230,000 times ROM's interest ratio, 20%. So ROM's capital interest is 46,000 only. In contrast with his investment of 60,000, there's a difference of 14,000. This will be the bonus to old partners. Then the old partners will share with the 14,000 bonus. So for RAM, we have 4,200. For RAM, we have 7,000. And for RIM, 2,800. Okay? Then after the admission of uh, okay, the computation of ROM's capital interest, we'll have it the 46,000. Okay? So I'm just showing you the effect of the bonus. Okay? Because the bonus will not will not really affect at all uh, the no, the total capital interest when it comes to total. Rather, what is being referred here as the contributed capital not equal to agreed capital is only referring to uh, ROM, okay, not the total. The previous example, the revaluation and the goodwill, the the what is referred to as contributed capital and agreed capital is the total agreed capital that we have. Okay, so we have it 46,000. Okay, so in our analysis, still the same. Okay, so RAM will have 54,200, RAM will have 72,000, and RAM will have 57,800. Then ROM will be decreased by the bonus that he will be giving to the old partners. So debit cash for 60,000 and ROM capital for 60,000 to record the investment of ROM. Then debit ROM capital for a total of 14,000 for the bonus and credit the respective capital of the old partners for the respective share in the bonus. The next, I guess this is the last. Okay, bonus, this time bonus to new partner. ROM is admitted as a new partner to invest cash of 30,000 for 20% interest in the partnership upon its admission. Okay? So, to compute for the bonus, it should be to new partner. Computation of bonus to new partner, we have it 200,000 total contributed capital, old partnership capital plus the investment of 30,000, multiplied by Rom's capital interest ratio of 20%, we can have Rom's capital interest of 40 versus the Rom's investment of 30,000. So bonus to Rom 10,000. Okay? So aside from the investment, Rom will have a bonus from the old partners. So old partners uh, will share in the deduction of the bonus. So 3,000 for RAM, 5,000 for REM, and 2,000 for RIM. So competition of capital interest of ROM will have it again 40,000. Okay. Then for the analysis, RAM will have be deducted 3,000, so 47 for 47,000 for him. REM will be deducted 5,000, so 60,000 for him. RIM will have deducted 2,000, so 53,000 for him. Then ROM will be increased by 10,000 bonus, 40,000. Okay? So debit tayo ng cash for 30,000 cash investment. Then ROM capital, 30,000 credit. Then debit respective capital accounts of old partners for the share and the bonus given to ROM as new partner. Then credit ROM capital for the total bonus of 10,000. Okay? So that's it with our part 1 of our partnership dissolution. To be continued.